Hey everyone, this is Luke Wilgram, Seeking Alpha contributor and investor. Today we're taking a look at Xpel Inc., ticker symbol XPEL, on the NASDAQ. First though, a quick disclaimer. This video is not financial advice in any way and is for educational and informational purposes only. Investors should not rely on information from this video and should do their own research. Investing can be extremely risky and you can lose all of your money. In the interest of full disclosure, I do own a very large position in Xpel. Okay, with that out of the way, we can get into it. So if you're not familiar with Xpel, they are the leader in paint protection film, that's what they sell, or PPF for short. And they also sell software related to the installation of the film. That's called their Design Access program. The company has a patent on their software and it's a key piece of the company's competitive advantage and moat. Although I'm not going to get into this in this video today. Some of my previous Seeking Alpha articles have covered this, so definitely go there if you want to read those. Taking a look at the last 5 years, you can see here. Let me just get my pen tool going. In 2013, the company did just under 18 million in revenue, and they've now grown that in 2019 to 130 million in revenue, just about, not quite. Now, take notice that the growth rate in revenue in 2018, which was a great year for the company, was in the 60% level, and then in 2019 it dropped to just 18%. So we're going to take a look at what happened in 2019, but for that we need the quarterly revenue numbers. So here is the quarterly revenue numbers for Xpel for the last quarter of 2017. You can see 2018 here, these 4 quarters. The company did very well, including almost doubling their growth in revenue in the first quarter of 2018. That is when I found the stock and I began investing. Since then, they've been growing revenue not quite as fast, but still impressive until you get to the first quarter of 2019 here, where you see a negative 1.5% growth rate. They only did 24 million compared to 25 million in 2018. Now that was because of an inventory build in China. Basically, the company sold inventory to their distributor in China, and then that inventory built up and didn't get sold throughout the country in the first 2 quarters of 2019. So you can see the growth rates there took a bit of a hit. Meanwhile, pretty much everywhere else the company continued to grow, so I maintained my position in the stock. I thought China would recover, and sure enough it did. You can see by the Q4 of 2019 here, they were back up to almost a 50% revenue growth rate, which, by the way, they grew profits even faster. And then in Q1, we dropped to about 15%. Now, the reason for that is because of COVID-19. Obviously, that has wreaked havoc across markets in 2020. For Xpel, mostly it was their China revenue again. So back in 2019, China took a hit. Here in 2020, China took another hit because of COVID-19. But what I want you to take a look at here is the company's margins. Going back to the first quarter of 2017, you can see they've just, for the most part, maintained this uptrend, especially the gross margin here. And even though revenue only grew about 15% in Q1 2020, gross margin grew to 36%, and that has a big effect on the bottom line. Now you can see operating margin and net income margin declined in Q1, and that's due to the company investing some of the money they made back here. So they're spending it on marketing and things like that, which ultimately will benefit the company in the long run, even though they're sacrificing some short-term profit. So here I have their quarterly income statement highlights numbers. So we have, let me get my laser pointer tool, revenue growth rate, revenue, gross profit margin, operating profit, operating margin, net profit, and profit margin, and then I included earnings per share. Now, what I want you to notice here is Q2 of 2020 to Q4 of 2021, I've put in my own forecasts. That's the light blue here. So let me explain some of those. If you look back to Q1 2019, that's when they had that inventory build in China. They grew 15% here. I'm expecting about a 10% decline in Q2 of 2020, and the reason for that is COVID-19. The company is probably going to take a hit everywhere outside of China. Now, they did say China in Q2 would recover and should be up about 100% from last year. That's good, but I'm expecting about a 20% decline in revenue in most other regions. So that comes out to about a 10% decline for the company overall. That'd be 27 million in revenue. Also brought margins down to 33%, gross margins that is, from this 36% they did in Q1. And the reason is that in China they have lower gross margins, and if China's revenue is doubling and everywhere else revenue is declining, we're going to see that gross margin number come down from Q4 a bit, or Q1, sorry. Then I have them doing 12% operating margin, 8% profit margin. That might actually be a little bit aggressive. We'll see what the numbers actually come out to. Then in Q3, I have them rebounding back to 20% growth. Same thing in Q4. So right there and there. So that puts them at about 43 million and 47 million in those two quarters, ultimately earning about 18 cents and 21 cents, or I guess 19 cents in Q3 of 2020. Then if we jump to my annual forecasts here, there we go. So you can see in 2020, when I combine my quarterly estimates, that results in a overall growth rate of 12.06%, or 145 million in revenue, 34.5% gross margin, 12.75% operating margin, and about a 10% operating margin for EPS of 53 cents per share. Now, if we jump back to the quarterly revenue here, this is, I think, the most important thing about this company, what they can do in 2021. Now, let's look at my estimates here. Q1 of 2021, I have a 50% growth rate. And you might say, wow, that's really aggressive. But think about what's happened the last 2 years. Q1 of 2020, you had COVID-19. Q1 of 2019, you had an inventory build in China. So, assuming nothing else crazy happens in Q1 of 2021, that growth rate should be very high. Still, that's only 42.5 million, which is less than I'm forecasting in Q4 of 2020. They could very well beat their Q4 2020 numbers in revenue, and that's only slightly more than what they actually did in Q4 of 2019. So I think that's pretty reasonable. Then I have gross margin again coming up to about 35%, 15.5% operating margin, and a 13% profit margin. That's 20 cents for the quarter in EPS. Then going to Q2, again, another really aggressive growth rate here, 60%. And the reason for that is in Q2 2020, I'm expecting a 10% decline, but I'm expecting the company to recover by Q1 2021. That puts, let's see, where are we here? Right here. That puts revenue at about 43 million, up slightly from Q1. Seasonally, Q2 and Q3 are Xpel's strongest quarters. Ultimately, I have profit margin increasing to 13.5%. That was a bad circle. Let me just redraw that. And then, so at a 13.5% profit margin, that leaves EPS of 21 and 25 cents in those quarters. Finally, in Q4 of 2021, I'm expecting them to come back down to 20% growth rate. By the way, that's what I had for Q3 as well. Same margins across the board for Q3 and Q4. And that leaves about 28 cents in EPS in Q4 of 2021. Now if we jump to my annual estimates here, that combining my quarterly estimates gets us this right here, 2021. So I'm expecting about 30% growth, more than 30% growth, almost 200 million in revenue. At a 35% gross margin, that gives them almost 31 million in operating profit. If they can hit my numbers, they'll do almost a 16% operating profit, which will give them a net profit of a whopping $26 million in 2021. Divide by shares outstanding, that gets you to 94 cents in EPS. Now, I did want to cover regional revenue here. So you can see here, I've included the countries here, and that circle is off, but you get the idea. You can still read it. This was in Q1 2020. This is Q1 2019, so last year. You can see the US did well. China, of course, because of COVID, we had that 50% decline. Now remember, next quarter, that's going to be a 100% increase in Q2. Canada did all right. Well, actually pretty good. And you can see every other region, they grew pretty nicely for the most part. Here's their growth rates over the last 4 quarters over here in percentages. And the website I got this from didn't include the quarters, but this would be Q1 2020, and I'm not going to draw all of these out, but this would be Q4 2019. This is Q3, and this was Q2 of 2019. So you can see in Q3 and Q4, the company grew significantly in every single region. Then in Q1, COVID hits. China takes a hit. Asia Pacific took a bit of a hit. And Latin America took a bit of a hit, although not much. Every other region grew substantially, and look at this Europe number. 96% growth. And then look at here, where's Europe here? They only do under 3 million in revenue in Europe, and they're growing at 100%. And Europe is a far bigger market than Canada, and they do almost double the revenue in Canada that they do in all of Europe. Europe has more than 10 times more people than Canada. So the potential in Europe for Xpel is absolutely massive. Obviously, China has a huge population as well, so the opportunity there is huge. And then the UK even is substantially bigger than Canada, so there's a ton of potential there too. So let's jump back to my annual estimates here. 94 cents, again, that was here, in 2021 as a multiple of earnings compared to the current stock price. The other day, the shares closed at $15.75 per share. That puts a 2020 earnings multiple of 31 times on the stock. That seems somewhat reasonable considering the growth rate. I mean, if they only grow 12% in 2020, 30 times earnings could be actually a little expensive. But that's not what matters here. What matters is the 2021 number, 94 cents per share in earnings. That puts the stock at 16.7 times 2021 earnings for a company doubling earnings and growing revenue 33%. That is, in my opinion, really cheap. And the stock has come back from $7 a couple months ago, I think the low was. So in my opinion, Xpel is a really great company, which I didn't get into too much in this video. But I really do think they're a fantastic company. If you go back and read some of my articles, you'll see why. I think the valuation is ridiculously low, and that is why it's my largest position. If you like this video, make sure you hit the subscribe button, share it, hit like, make the YouTube algorithm know that you liked this video, and let me know what else you want to see. Did you like this? Is there something else you would have preferred? Let me know. This is my first video, so I'm looking for feedback. Thanks. I'll see you next time.